Good day, all. Ira Epstein of Linn Associates with your financial market wrap-up, and this is your weekend edition, and this is for Thursday. I almost said Friday there. It's Thursday, April 9th, 2020, about 5:45 p.m., and that's Central Time. I want to wish you all the best holidays of Easter, Passover to everybody. It's unusual what we're doing. I'm generally with family at this time. No family, just alone here. It's different. I must share that with you. Today was an interesting day in the financial markets as the Fed threw the kitchen sink at the market. Now there's more left. They have more sinks to throw, but they really threw another great one. And anyone that's knocking our Fed and saying they don't act, this was a phenomenal move that they made. Whether it works or not, it's not the issue. The issue is they're really acting, and they're acting boldly, and they're not waiting on the market. They're ahead. They're trying to get ahead of this whole thing. So they threw out today a $2.3 billion package that the Treasuries with them on this. That way they don't have to worry about Congress coming around the corner. What are you doing? How much money are you throwing out there? Blah, blah. And the idea here is to help counties, municipalities, business. That's what this package is all about. Now, I haven't yet seen what's so different about this package than the ones that they threw out earlier, but I haven't had time to review it. I'll do that over the weekend, and then I'll be more versed in what it is. What I do understand is that it's a 4-year loan, which is different. There's no interest on the first year. I don't know if you even pay back principal if you have to on the first year, but the other years, that's where everything kicks in. So we'll see what this does, but I can imagine the doors are going to open up. I live in Chicago, and we're basically broke, so will they take our collateral? Because you do have to put up collateral for it. That's what we'll find out, one way or the other. This is not for people. This is for business, counties, and municipalities. But again, they wouldn't do this unless the market's looking over this, if we call it the curve. Keep that in the back of your mind. They wouldn't have done it today on the day where the jobless claims came in, and that just took the thunder right away from it, and this market was up. Now, it gave up the better parts of the day, but so what? It was still a very strong day, and what a week it has been. And if you think it's easy to trade these markets, think again. This is not volatility that just about any of my contemporaries, any brokers I know, are used to. You may be used to it. We're not used to it. When you look at a monthly chart of the S&P, you've gone from 3231 down into this break low area here, and that low was, what, 2569. Remember, this is a monthly chart, so you broke roughly 700 points, and you're getting a bounce back. Okay. You haven't made it halfway, but you're getting a bounce. When I take a look at a weekly area chart of closes, the game changed. Now, when did the game change? Changed this week. You had a bounce, but if you can get over this hump right through here on a close, that changes things because now you've got higher lows, higher highs on just a closing basis. When I look at where the Fibonacci numbers were, we had stopped, and we had stopped for 3 weeks at the 38% retracement level. You've now carried the market further to the 50% retracement level. It's still a 50% retracement. It is, by most technicians, a bounce in a bear market. I know other people will say it's the beginning of the bull and it's off to the races. Okay, I'm not in that camp. I'm still a traditionalist with this, having had the experience that I have. The next thing I look at, maybe I'm wrong in my thinking. And you always are thinking that. But then I look at where my swing line is. I've got lower highs, certainly lower lows, and I have a leg that's bouncing on the weekly chart. I look at where the 200-day moving average is. It happened that the market went down there, came back, and out of this past 1, 2, 3, 4, out of past 5 weeks, it's hit it most of the time, 4 of the 5 roughly. When I look at where the market's lifting up to, if it's moving away from the 200-day average, the 100 is waiting as the next resistance zone, okay? And then the 18-week. You have to get through both of these averages to take out the last rally high of 31.37. My point is that's going to be very difficult. When I look at momentum, momentum is pointing to the upside. So I have the bias down since the market's trading under the 18-week average of closes. I define bias as where's the market in relation to that. It's underneath it. Therefore, the bias is down. Certainly, the swing line trend is down, but momentum turned up. 2 of the 3, it's a correction in my opinion. When I take a look at the Nasdaq, not much different. Lower highs, lower lows. Market held, and here, by the way, is the 200-day average, made a run at it one time, but the battleground, instead of the 200-day that we just saw on the other chart, it's the 100. And we've hit it 1, 2, 3, 4, 5 weeks in a row. We have been either side of this market moving up and down in an extremely volatile market. If it follows through further, I'd look for resistance at 86.22, and to prove that the market has done something radically different, it would have to get over 90.0250 to break the longer-term weekly swing line pattern that is still in the bear camp. In the Dow, lower highs, lower lows. So we had a market that, if we take a look at it, got right through here, and the market battle was, we closed this week at 21,437 under the Bollinger Band. This week we finished at 20,255, way under the Bollinger Band. I want to come back to this one. That was the one we just discussed. Another one under the Bollinger Band, and this one was under the Bollinger Band. We had 4, and then we had our 5th. You've heard me say this over and over. 5 is typically the most you go. It's like pulling on a rubber band. You generally bounce away from that. Are there times it doesn't? Of course there are. Nothing's all the time. I don't know anything that's all the time. Death and taxes I get, but even taxes now, they're putting those back, so maybe death is going to be the next one that gets put back. But in any case, after that occurred, you move to the right and you're getting your bounce. That's what I'd expect. So the market got away from that thrust to the downside. This is a normal bounce, and you tell me where this market stalled, right at the 200-day average. So I'm still very much thinking that this is a bounce in a bear market. When I look at the Russell, a little different, but it's been different all the way through this year. But this market flashed a signal that says, no, I'm no longer in that camp with the other indices. I've got higher lows and higher highs. I can accept that. So if this market's going to come up, well, first off, it's not a trend play because you're under the 18-week average, so the bias is down. When the swing line's up, bias down, you have nothing. They counter each other. Momentum trying to turn up. But I respect the fact that this market's trying to give us a better bounce than some of the others. In the VIX, it's no different than I was pointing out to you that you had stayed so much the other way in the stock indices. Here's 1, 2, 3, 4, 5 weeks in a row where you were over the upper Bollinger Band. The odds favor you're going to come back to the right-hand side now. There and there. And that's my own rule. It's not a Bollinger Band rule that I know that John Bollinger, and I know John, that he developed. But I looked at it over the years after I learned his technique with it, and I just added to it. It's what I did with slow stochastics. You try to put your own flavor to it. Maybe you see something. When I look at 10-year notes, I've got higher lows, and now I've got lower highs. So the market all of a sudden has started this. It's paused itself out. Momentum is still up. Remember, on the weekly charts, it's either up, sideways, or down. So it was up, but it's still, I can still say it's up because the 80 number is over the 79.90. So it hasn't crisscrossed, but they are very close. You could argue that they're going sideways now. In the dollar index, we're still in an uptrend, higher lows, higher highs. You could turn into a downtrend like this in this market if you get under 98.39.5 on a closing basis. You would then have lower highs, lower lows, and this market could be then setting itself up for the 100-week average and then maybe some other averages under the market. In the eurocurrency, the market is, well, it's under the 18-week average. It's in a downtrend. Lower highs, lower lows. So still bearish here. Has not turned the corner. Resistance is at 110.54. It would have to get over 111.83.5 to turn the corner bullish. In the Canadian dollar, the market, after this large break here, got back to the right-hand side of the Bollinger Band. Now, this week's high was 71.86. 71.88.5 is the last high. If this market can clear that 71.88.5, I'd be willing to declare it's out of its downtrend. That doesn't mean it's bullish because you're still under the resistance point of 74.49.5, the 18-week average. But I think this leg would then be over in the market. In the Japanese yen, the market has still got bullishness to it. You still can't argue that you got higher lows. You certainly had a higher high, or do you? What if I tell you you now have that high with a lower high and higher lows? You're coming in like that again in the market. So this craziness in the market came to an end like that, and the market's gone back into the Bollinger Bands where it stays 95% of the time. Bitcoin. On the weekly chart, you still have the lower high, lower low pattern. We've had a bounce up to the 100-week average where we've played for about 2 weeks. Resistance is the 18-week at 8,006. Now, this chart it's not my favorite chart. Let me explain. When you go to the weekly charts, the way that they're set up, this is going to be the May crude versus the June Brent. It's not accurate. If you want to see the differentials, go to June to June. But it's always fun to see. But the May Brent went off the board. But in order to do weekly charts, this is what technicians do. Let's take a look at the weekly Brent crude. All you've done is climb back into the lower part of the Bollinger Band, the right-hand side. You had been 1, 2, 3, 4 weeks in a row. I don't think this one was the 5th, but it could be. This one was under it, so that's 1, 2, 3, 4, 5. You know what I say? If you get to that 5th, it's pulling that rubber band, watch out. The market popped back, and that's what you're getting. What the market's done now, it has not changed its trend on the weekly chart. It's still bearish at this point. You'd have to get on the current formation, and these formations change over time, over what, 60.82 in order to break that. I don't think it's going there anytime soon. In WTI crude, different pattern formation than on the Brent. Here you've got higher lows and a higher high. Now, what would hurt this market badly is if this week, that's the only week I care about, if the market got under this 1927 level. Why? My rule of thumb is that you should not take out a low of an outside week up or down, the high of the outside week down, the low of the outside week up, within 2 time frames, which is a week each. So, and if it does, it's a false signal. So we'll see what happens. In the gasoline, again, just move to the right-hand side in here. You still have momentum, hasn't turned up. The bias is down, still in the bear camp. So when I put it all together, I'm still not friendly in a lot of these markets. I'm looking at a bounce. I realize that may not be in fashion with a lot of traders. Okay, I don't have to be in fashion. I just look at what I think the market's doing. And what I'm trying to avoid, and I really do, is second-guessing myself. And I know you find yourself doing what I do. So in the mornings, I wake up, now that my office is here, it's so easy, and I'm recording about 5:40 in the morning, 40 charts for you. And in those, I'm saying, buy here, sell there, do this, do that. There's a charge for it, $7.95 to give it a try. I don't think that's going to break the bank for 40 charts. It's about a 20-minute long video full of fundamentals, because I've already read what's going on in Asia, Europe, and the U.S., so I'm going to bring that to the table. It starts off with them, and then trade ideas galore. And the idea there isn't for you to follow me. The idea there is for you, if you have your own idea, maybe this either points out something wrong with it or something that confirms what you want. That's the idea. If you're a regular watcher here of this, it speaks volumes that you must think you like what I'm saying. If you're turning me in to hate me, that's unusual. I wouldn't spend that time, I'll tell you that. But if this makes sense for you, give it a try. Go to our website, under research, sign up for that. It's what also keeps these shows going, my friends. If I can't make it for that, then I won't do them. In any case, I'm Ira Epstein. You have yourself a great holiday. I'll see you all come Monday.